Well, hello everyone, and welcome to our presentation today here at TradeStation. My name is Don Prattle, and I am the Director of Trader Development and Education here, and I want to welcome everybody to our presentation. Certainly our presenter, Mr. Leo Valencia, or Dr. Leo Valencia, as I want to introduce him and put this all in context for us. Leo Valencia is the host of Gamma Optimizer Option Service at ElliottWaveTrader.net. I've posted that link in the chat panel. I'll be happy to repost it later. Dr. Valencia is an electrical engineer with more than 20 years of experience in research and development projects with a PhD in physics from Stanford University. He was a member of the technical staff at Bell Labs Lucent Laboratories in the RF and analog simulation department, and also a senior member of the consulting staff at Cadence Design Systems for more than 15 years, working on both analog and digital simulation software projects. Now, his expertise is in the area of software development for highly specialized and mathematical problems, which brings him to his thesis that he's going to share with us today about optimizing our options trades, or optimizing your option trades particularly. Now, one of the founding philosophies here at TradeStation, and one that has driven much of its success over the past 25 years, is based on the reality that rings true with so many people, is that we shouldn't trade or invest on gut instincts, or on rumors, or on what we hear on television, or don't simply react to the wisdom of trading gurus who claim to know better, or the thousands of books and pamphlets that tell you the best ways to get rich in the markets. And one of the things so that's why we need tools like the tool like the Gamma Optimizer that Leo Valencia is going to talk to us about today, and certainly the way that it applies to options trading. Now, our presentation today is for educational purposes only. All the symbols and all the trading ideas that we discuss here are for demonstration purposes. They are not recommendations. This presentation is not an offer or a solicitation of any kind in any jurisdiction where a TradeStation affiliate is not authorized to do business. Active trading is not suitable for everyone, and options trading itself carries a high degree of risk and may not be suitable for all traders. I have pasted into that chat panel a couple of pieces of disclosure information regarding the characteristics and risks of standardized options and some of the other asset classes here at TradeStation. Which brings me to Dr. Leo Valencia, and I'll turn things over to him right now, and he's going to talk to us about how to find that needle in those haystacks with his long Gamma Optimizer. Now, usually about this time, someone will ask, is this presentation being recorded? And the answer is yes, we've been recording, and we will record and have this event posted to our TradeStation University site sometime tomorrow. This will also be available in the TradeStation YouTube channel. And if you are a TradeStation user already, we hope that you will become a TradeStation user soon if you're not. But if you're already a TradeStation account holder, the presentation will be in Video Station tomorrow. So I'll turn things over to Leo right now, and I'll mute myself out. I'll be available for questions in the chat panel.
Thank you, and thank you everyone for joining us this afternoon for this webinar about options in particular, and also about the long Gamma Optimizer, which is a handy tool I created for my own trading and that I have shared with other people at the ElliottWaveTrader.net website. So what is the point of this presentation? So the point of the presentation is to try to understand a little bit more about options, and in particular about what is Gamma, about why Gamma is so important for an option trader, and how to optimize it. No, that's the whole point of the optimizer. So I'm going to talk a little bit about Gamma, and probably at the end I'm going to barely mention the optimizer, but the whole idea is to teach you folks about Gamma and how to trade it and how to optimize it. So the problem becomes this: when you are used to trading shares or futures, those products are simple to trade. Those products you only have one of those or probably a few of those, and then you trade them. But with options, is there are too many of them. No, there are thousands of them. For instance, for the SPX index, we might have 8,000 options between calls and puts, different expirations, and an infinity of strikes. And even for single names, even for stocks, highly liquid stocks like Apple, the amount is also staggering. Now, Apple might have 1,500 options between calls and puts. So as a new option trader, I guess that's the first reality you're faced with. You're like, okay, I want to trade options, but what? What is this? I have 1,000 of them to choose from. Even if you have a basic understanding of the mechanics of options, it becomes daunting to do that. So that's what this presentation is about. And to help you do that, I'm going to talk about gamma and other demons. I just kind of little attempt at humor here. But more exactly, I'm going to talk about optionality and the difference between optionality and leverage, and also why optionality is not leverage, and even furthermore, why optionality is superior to leverage. So we'll see that through the presentation. I think the first thing that you discover when you move into the world of options, and I guess it could be surprising to new people, is that options lose money with time. It is a fact of the universe. If you buy an option, you hold it, and every day you are holding that option, it is losing value. And you know, it's disheartening to see it. It happens, and I guess you talk to your friends about it, and everyone says, "Oh yeah, options decay with time." But the question is why? Why do options decay with time? I mean, why do they have to decay with time? Why shares, for instance, don't decay with time, or futures? No, like futures that have actually a settlement date, which is kind of similar to an expiration date in our minds. No, why the futures don't decay? Why the options decay? So the answer to the question is the whole core of this presentation. I am approaching gamma from a time decay perspective. So time decay is simply an extra cost that you're paying for the option. So when you buy an option, you pay whatever is the premium of the option, but you're also paying time decay for it. I mean, when every day that passes and you're losing money, is an extra cost associated with the position. And it is in exchange for something that is called convexity. So convexity is a word that might be familiar to some of you. No, it is kind of it is in opposition to linearity. When you have a convex profile, it's like a satellite dish. No, something that has a nice curve or like a lens. No, so options, amazingly, are convex instruments in the sense that the profit and loss profile, I mean, when we are computing our profits or our losses, they don't change in a linear way. They change in a convex way, in a non-linear manner. And that convexity is what causes time decay, because whoever is selling you the option is demanding time decay because they are assuming extra risk for that convex profile. So convexity is the price, time decay is the price of convexity. And in this discussion, I'm going to mix all these words. When I mention convexity, is the same thing that optionality, and gamma. Gamma is just a way of quantifying that convexity. So here, as I mentioned before, most people think that options are linear, because we tend to think about options as, oh, I'm going to buy this call option and it's going to expire, and if Apple finishes 10 points above whatever is my strike, I made $10, and it seems very linear. It seems that every dollar that an option is in the money is a dollar of profit for you. So we tend to think about options in a linear way, but options are non-linear, and in fact, most of the most profitable option trading is the one that is performed before the auction expires. So my style and the style we have in the Gamma Optimizer, we never let the options expire, never ever. We carry the options for a period of time before expiration. We open an option trade tomorrow and we close it 1 week later. We never let them expire because it's in that period of time before the option expires that we can actually see the power of the option. We can actually see optionality or convexity in action. So So this is something we have to consider. I mean, most newcomers to options buy them and cross their fingers and hold them until expiration and wait for their profits or their losses. But I mean, if we're trading this for a living, if we're trading this to actually make serious money, it has to be considered in a different way. So we have to trade and take profits before expiration. And here, finally, there is a graph. No, this is a graph about what is the profile is. So this is what I was talking about. This chart is very simple. It's just a profit and loss profile. The x-axis represents different levels of the underlying, which in this case is SPX. And the y-axis is the profit in dollars. No, this is like real dollar profit. You can see that I created this chart a long time ago when the market was still at 2,390, you know, or probably even lower. It was 2,370, and the option was for an out of the money call option. So this is a very extreme chart. I made this deliberately, and this was a real option. This is an option, and the pricing was like real time pricing, all real parameters. I have not invented anything here, and the option only cost 82 cents. So you can see here in this chart that if the market start moving in the direction of the option, which is a call option, you can see the profits quickly accumulating. And notice this, I mean, the profits don't go up in a linear manner. It's not that, oh, for every point that the market goes up, my profits go up a certain amount. No. Notice how the profits accelerate. Gigantic. I mean, there is a point, for instance, at 2,400 where the profit was $12 when the cost is only 0.82. This is a massive profit. You know, it's a tremendous, gigantic profit. And even for moves that are not that big, for instance, for 2,385, you can see it's already $4, which is probably 5 times what you pay for the option. So you notice that convexity is a very powerful thing. If the move happens in a short period of a short enough period of time, the profits accumulate really quickly. And notice also what happened to the losses. The losses don't accumulate. The losses are basically limited to the premium you pay for the option, and they don't accumulate. In fact, it kind of moves towards that value slowly and nicely. So this here, Fox, is a convex profile. Nothing else exhibits this profile. I mean, nothing that you trade usually, like futures don't show this profile, or shares don't show this profile. In shares, you have linear profit and losses. Even in leverage products, it's all linear. That's why I mentioned at the beginning of the presentation that optionality is superior, convexity is superior, because convexity is kind of like the the magic thing we are looking for. We were looking for something that multiply our profits, but they don't do anything to our losses. Leverage is kind of like a way to get killed really quickly because it multiplies both, multiplies profit and losses. So this is why convexity or optionality is superior. However, as we saw in the first slide, we are paying time decay for this privilege, no? But, you know, keep it in mind. It's a good deal, I guess, in general. So now let's talk about gamma. So now I'm going to formally introduce gamma to you folks. Gamma is just a number. It's a number, you know, between 0 and 1, or, you know, you can define the scale as you wanted, that represents convexity. No, it's just a way to quantify the convexity of an option. So, for instance, let's look at it. I have a chart here that has the same option, I mean the same strike, but for different expiration times, no? And those were also very real options at that time when I generated this chart. And you can see, you know, I have options that expire 2 days from now, which is extremely short, 14 days from now, 25, you know, 53. So you can see the behavior, the profile of the profit and loss chart for different expiration dates, and you notice differences between them. You notice how the shortest, the nearest term option has a very convex profile. I mean, this is the most convex of all. This is really lots of non-linearity. It grows really fast and it has small losses. But as time as I pick options with longer time on them, you notice that that convexity starts to disappear. You notice, for instance, the green line um, represents the option at 14 days. And at 14 days, there is some convexity, but not that much. And finally, notice at 53 days, this purple line here looks very similar to a straight line. It has some convexity, but it has very little of it. So if I want to mathematically represent in a numeric way, if I want to talk about this, I could say that the 2-day option has lots of gamma on it, while the gamma for the other options is very small. That's what I could say. So notice the gamma value, the numeric gamma value, the gamma that describes the convexity of the option, changes with time to expiration, or is affected by time expiration. The longer something it takes to expire, the less gamma it has, and vice versa. The shorter the expiration of the option, the higher the gamma. And this is an extreme case. An option with 2 days has gigantic amounts of gamma on it, and you can see it. So let's continue talking about gamma. No? It is very important. No? We are going to optimize gamma. Let's try to understand more about gamma. So in the previous slide, we saw that gamma changes with time, and that it has a tremendous relationship with time. Now let's look at strikes, no, what we call moneyness, but let's call it strikes. It's easy. So this is all of the options in this chart expire on the same day, which is only 2 days from now. All of them expire in 2 days from now, but they have different strikes, or what more formally is called different moneyness. No, so like 2,370 is barely out of the money, but then 2,400 is incredibly out of the money. And you notice an interesting behavior, even for the same expiration time, as you know, the longer or the farther you go out of the money, the more optionality you get. Notice that the 2,400 option is very convex. It has tremendous accumulation of profits and almost no losses. But notice how, as I get close in the money, the optionality is changing. No? And the closest option to the money actually has optionality, but it has less optionality or less convexity than the far out of the money. So this is kind of giving us an idea. Okay, wait a second. Gamma is something very interesting. It depends on time to expiration, and also it changes with moneyness. It changes with the options we pick. So this is kind of mind blowing. So we want to maximize gamma, but gamma is changing on us all the time. So to help us with this is kind of a three-dimensional chart for gamma. Now, let's think about this as as a three-dimensional chart where, okay, I have different strikes for the options. The x-axis contains options with different strikes. The y-axis is gamma. So this is actually a chart where I can see gamma. We are not seeing profits or losses anymore. We are actually seeing the numeric gamma. And the colors represent the time to expiration. So I have 3 dimensions represented here. Now I'm kind of like classical chart with 2 dimensions, and I'm kind of cheating with the color for the 3rd dimension. But it allows to see the way the gamma actually behaves in options. And again, all of this data comes from real options. No, I'm not making this up. This was computed from a true volatility surface from SPX at that time. So let's see some features of gamma. And these features are very useful for every option trader. I mean, this chart condenses lots of interesting information that applies for many styles of trading. And I love it because it's a very simple chart, and yet it's telling you lots of information, and it's giving you already some strategies from the chart. So before going into detail, let's start looking at a couple things. Notice how, in general, gamma is higher. Oh, well, by the way, the dotted line represents the current level of the underlying. So I think SPX was around 2,370 at that time when I generated this. So notice something. Notice that gamma is more plentiful on the strikes that are really near the money. Notice how it doesn't matter what expiration we are looking at. We can see that gamma is very high for around that point. In fact, it's probably the highest peak or the highest point of the whole gamma profile. So it is interesting, like just keep that in the back of your mind. Now, gamma seems to be more plentiful near the at the money strike. And that's a fact of the universe. And also notice something. Notice that gamma is kind of symmetrical. It's not quite, I mean, it's not that the at the money level is perfect symmetrical, but there is a symmetry. And notice how if an option is too far out of the money or too deep in the money, gamma is very low, which is interesting. So gamma doesn't accumulate or grows or slows down. No, it has this bell shape. Gamma goes up, has a peak, and then it comes down. And that is also something that you have to keep in mind all of the time because it affects option trading a lot. No? So we see those two behaviors, the symmetry between the at the money and the out of the money gammas. We see that gamma is more plentiful near the at the money, and also it's clear from this chart that gamma is more plentiful the closer you are to expiration. So the option with 2 days on it has gigantic amounts of gamma in this area. And the further options, for instance, this one with 25, the purple one, barely has gamma. Now it's like, okay, we have some gamma, but not that much. Okay, so with this, we can see lots of things. I'm going to start enumerating a bunch. So if you have questions, just don't let me go too far. So the first consequence is, okay, options are fantastic because they give us optionality or convexity, whatever of the two, however you want to call it. Yet, the farther we go in time, the lower we are getting from that fantastic thing, no? So the farther away that the expiration of an option is, the less gamma or the less convexity you get. And I have a question. Will the inverse apply to selling options? Mike, this chart works for anything. Now this is gamma, and you can decide what to do with it. I will explain like strategies for buying and selling gamma. So the first thing, so for a gamma buyer, if you are a gamma buyer, if you want to play direction or if you want to benefit from optionality, don't go too far. I mean, if you trade options that expire 1 year from now or 2 years from now, those options are called leaps. It is pointless. I mean, you are wasting your money. You are not using options as they were designed for. No, options were designed to provide optionality, yet you are using options that have no optionality. Look at how low gamma is for 25 days. Imagine an option with like 400 days or 500 days or 1,000 days. Like gamma will be almost zero. So those options don't serve the purpose you think they are serving. They don't give you optionality. You are a long gamma trader. The other thing is, look, that is pointless to buy at the money options. And I let this sink. So what happens if I buy an at the money option? So I'm buying peak gamma. Basically, that's what I'm doing. I am paying for a lot of gamma upfront. But what happens to gamma? What happens once the market moves up or down? So you can see in the graph, if the market moves, gamma decreases. It doesn't matter what side it moves, gamma just kind of it falls, and it falls dramatically. It's not like a little fall, no, I mean it's a dramatic fall. So if you are a long gamma trader, if you are a person, a trader that I like to buy options, right here you can see that buying options that are in the money is incredibly inefficient. And it's incredibly inefficient because yes, you are getting upside lots of gamma up front, but then after the market starts to move, just a little bit, it just moves a little bit, then your gamma starts to decrease, and then the convexity of your profits starts to suffer a lot. So as a long gamma trader, don't do it. No, there is no point. But I mean, there might be some justifications what to do it. But in general, that's what I'm trying to show you, that it's not an efficient trade. However, there is something that is even more inefficient. Something that is more inefficient is to buy options that are deep in the money. That's super inefficient because notice what happens. Let's say you buy an option that is here. So you're buying low gamma because the option is already in the money. What happens if the market moves into this direction? I mean, the option will become more are more in the money. So you buy an option that has low gamma, and what happens to the gamma of that option? It starts to come lower and lower and lower. So as a buyer, you are wasting your money completely with a deep in the money option because your profits are not accelerating. In fact, your profits are decelerating because you started with very low gamma. I mean, and the more in the money you go, the worse gamma you'll have, and it will decay even faster. And I have a question: is the conclusion to sell weekly call options near the money? Well, I don't know. I mean, the conclusion is if you are a gamma seller, yes, what you want to sell is peak gamma. I don't know about weekly call options. No, I'm not um, suggesting that you should do that. But in general, if the thing that floats your boat is to sell gamma as a gamma seller to collect premium, of course, sell this area. This is the area that has the most tasty gamma to sell. No, this is the one that has juicy gamma, and sell it. And also notice how, as a seller, you benefit greatly because the market moves, and then your total short gamma exposure will be reduced. So as a person that is short a quantity, you will love this behavior. You will love to short here, and then if the market moves, you are short even less. So you notice that that short gamma works in this area, but long gamma doesn't work in this area. So yeah, as a seller of gamma, you pretty much do the opposite of what I'm suggesting for the long guys. So what are the options then? Then, well, and I know lots of people love to buy deep in the money options because, oh no, I don't want time decay to kill me, and I want to be safe. And not only that, they love to buy deep in the money and really far out in time. Oh, and I want to buy time. I am expecting this to move next week, but I'm buying the 90-day option. Like, why? Why would you do that? If you are killing yourself. Not only you're getting a very few gamma because the option is in the money, you're also getting even less because the option is far dated. So if you're a trader, a directional trader, don't make those mistakes. As a directional trader, don't make the mistakes of shorting yourself in terms of gamma dynamics. Look at this. What happens if you instead decide to buy out of the money? So if you decide to buy out of the money, I'm not suggesting you buy here, but let's do the exercise. Let's buy an option in this area. So okay, the question is, please discuss selling deep out of the money options. Yes, so I am going to discuss buying deep out of the money options, and then we'll see how it goes for selling. No, you'll notice it's just basically the opposite. So look at this option. This option right here, it's hopeless, has no gamma whatsoever. And it should be incredibly cheap because remember, gamma is what makes options attractive. So this option is almost free. So you're buying nothing. What happens if the market starts to move towards you? So your option will become closer to the money. So the dynamic of the curve is this. The gamma of your option was nothing, almost zero. And then suddenly the gamma of your option starts to increase. And the more it moves towards your strike, the gamma is increasing, the gamma is increasing, the gamma is increasing, and your profits are just running. Your profits are just exploding because gamma is increasing. And notice when the profits will maximize your profits right here. The moment the market hits your strike is the maximum gamma for that option. So as a buyer, that's exactly what you want. As a buyer, you have to identify an out of the money option that as the market moves in your direction, it really benefits from it. And what happens if the market doesn't move? Nothing. It doesn't happen. Nothing changes for the option. So now let's talk about selling. So, okay, so lots of people are really attracted at selling options that are out of the money, either calls or puts. And I'm going to tell you right away, that's a terrible thing to do most of the time. And it's a terrible thing because it's a great deal for the buyer. So if it's a great deal for the buyer, imagine the seller is a terrible deal for the seller. Imagine that you never thought the market could reach 2,400, so you decide to sell this call here. Okay, so what did you sell? I mean, you sell pennies. That option costs nothing. So okay, you got some pennies. I mean, and you think you're safe with your little pennies in your pocket. But what happens if the market moves? It starts moving up. Notice how the gamma of the option starts growing and growing, and suddenly you're short this gigantic thing. You're short your responsibility if the option expires in the money is gigantic. So as a seller, you are assuming tremendous gamma risk if you sell deep out of the money options. The gamma risk is gigantic. And I will say most of the time that that risk is not worth it, folks. It's not. It is not worth because the risk reward of the trade is less than one. You're risking a lot of money and you're getting a little bit of money. So for a buyer, this is the best dynamic. And I have a question. To max efficiency, if out of the money call becomes profitable and looks like it will continue, should we close and reopen? Well, that's a great question. So lots of people are really good. I mean, I have seen it. People buy options that are far out of the money and the market moves and they maximize gamma, and finally the options become in the money. And the thesis is that the market or the underlying will keep moving in the direction of the trade, and they love it, and they just leave the trade on. And look what happens to gamma. Those guys are wasting the move. It's completely wasted because now the profits won't accelerate. Yes, you're getting money, but you're getting like, pocket change because you are not maximizing gamma. So to answer the question from Mike, yes, the answer is yes. The best thing to do is once the option has hit peak gamma, you should collect profits, and if the thesis is still valid, if the thesis is you still think that the move will happen, then look for a different expiration and another strike that is slightly out of the money so you can maximize gamma for it. So that's how you should do it. So you see, folks, this chart is fantastic. This chart is telling you lots of interesting things right there about what to do with options. Now, if you can memorize kind of the shape of the chart, you can figure out these roles. This is really easy to remember rules about what you want to do if you are an option buyer or you are an option seller. So, of course, the today option seems to win, but I am not advocating for trading options with such a short time frame. I guess because I included them in this chart, it looks like the best. But just be decent. I don't assume so much risk and they are on options all the time. So, but in general, try to stay near. Expirations that are not too far away, and try to buy cheap gamma. So let's keep moving. Sorry that I spent so much time on this chart. So now let's talk about the Greek alphabet. I have been talking about gamma, and as you can see, gamma for me, to me, is probably the most important parameter of an option. And you will notice that if you are an option trader with some knowledge, you know that there are other parameters for options. There are other things that affect option prices and option profits, and there are connections to them. So let's talk about the connections. The first connection is what we call theta and gamma. This theta is just basically time decay, and there is a connection, and the connection is mathematical. No, it's not just a connection. I just, oh, look, what a coincidence, there is a connection. No, the fact that options have gamma means that they have time decay. It's kind of a law of the universe. There is no way around this. I mean, I think the holy grail of option trading will be to find an option that has positive gamma and positive theta. If you find something like that, if you somehow manage to do that, you'll become a billionaire in no time, no? Because you are holding the best of both worlds. So this is the law of the universe. Theta and gamma are always of opposite signs. So if you have positive gamma, you have negative theta, which means you will suffer time decay. And the things are directly proportional. So the higher the gamma for an option is, the higher the time decay. So in this chart, of course, the gamma of this 2-day option is fantastic, but the time decay for that option is gigantic too. So there are no free lunches, folks. No, it's like if you go for the punch with the gigantic gamma, be prepared to have a gigantic time decay. And there is also another very important Greek, which is called vega. And vega is a parameter that relates the option price to something called implied volatility. And implied volatility is a concept. I mean, it is the way that options are actually priced by professional dealers, by option dealers. Implied volatility measures their expectations or future volatility. So if they expect the market or the underlying to be highly volatile, then implied volatility is high and the price of the option is high. Now, so Vega is how it reacts to it. And if the expectations of future volatility are low, then implied volatility is low and option prices are low. So there is a relationship between that sensitivity to implied volatility, which is called Vega, and gamma. And the relationship is that they are always the same sign. So if you have positive gamma, you have positive Vega. So you react positively to implied volatility. However, the magnitudes are inversely proportional. What it means is if you have an option that has gigantic amounts of gamma, the option has very little Vega, and vice versa. If the option doesn't have any gamma or very little, it has gigantic amount of Vega. And we can go back to the chart and see, okay, then it's interesting. So that means that, for instance, these options that are 2 days, they have gigantic amount of gamma. Therefore, they are very affected by implied volatility. So there is almost no effects of implied volatility in short-term options. However, these options that have low gamma, the 25 and longer, they are hugely affected by Vega. And in fact, for those of you that love to trade options that expire like in a year from now or 2 years from now, you are actually trading Vega. You are Vega traders because those options, the most important parameter for those options is Vega, because gamma is almost zero. So those options contain gigantic amount of Vega. And even if there are movements in the underlying, those movements will change the price a little bit, but the thing that will have a massive effect on the price is implied volatility. I have another question. Okay, gamma is very dependent on price direction. If selling deep out of the money, the direction of the market is not as important as time decay, whereby the option expires wordless and one can exit soon before expiration. Or let it expire wordless and keep the credit. Thoughts on this? Yes, the thoughts on this is don't do it. I mean, in general, there is no edge to that strategy. Selling really deep in the gamma, deep out of the money options with little gamma seems like a good deal to many of you. I mean, at first sight, it seems like a done deal. It says, okay, I'm going to sell an option that's 100 points up or 200 points down. And it will never happen. I mean, the market will never move 100 points up or the market will never fall 500 points and I get to keep my premium. And I will say, you know, folks, yes, but there is no edge. There is no statistical edge to this. I mean, you might keep your premium today, but the moment the market actually moves toward your strike, you will be so much in debt. You have so much negative that it will erase all of it. And that's something that we saw like with XIV, you know, with something like these products that more or less try to do that kind of a strategy, you can get wiped out really quickly if the move is against you. So I will not suggest. I mean, I'm not saying that I never do it. I do those kind of things, but not completely naked. There are ways to express those theses, but not with a full naked risk on them. You have to hedge the risk. So at least you are not going to blow up. I have another question. A back ratio with short legs used out of the money will seem to the ideal structure, but risk short going in the money and being assigned. Well, yeah, more complex structures like that, like a back ratio or like butterflies or like calendars, are actually good structures to do. Like, I mean, you can actually sell gamma. I'm not saying don't do it. I'm saying be really careful. Don't go too extreme and in fact never design positions that have a risk reward that is less than 1. I mean, never risk more money than what you're going to earn on the transaction. That's the easiest way to go broke in the market. No, always when you look for trades, always look for trades that will deliver multiples of your risk, because that's how you get positive edge on the long run. So, okay, so sorry about the detour. I was answering some questions. Let's go back to this, the Greeks. This is basically what I just say. Now I just say that options with high gamma have lower Vega and all that kind of stuff. And my recommendation, if you are trading options, and if you're trading options that are years away, like leaps, those options are not gamma plays. You are not playing optionality. You are actually playing Vega. You are making bets on the direction of implied volatility. For instance, to make an example that is more relevant, right now, implied volatility in the market is very high. No, it's very, very high. So if you buy options in SPX or SPY or ES for next year, for 2019, you are almost assured to lose money, no matter what the strike is. The reason is those options have gigantic gamma and are affected by implied volatility, which is very high. And in the long run, in a few months, implied volatility is going to collapse massively. It's going to come down a lot, and those options will lose lots of money just on that. Even if the market doesn't do anything, those options will lose lots of money. So your exposure to implied volatility is too high. So just be mindful of that when you do long-term trades. Okay, now we're coming to the to the meat of the presentation. I have seen in the questions that you folks are getting it, and I'm glad. I mean, so okay, we know about gamma, we know all of these features that gamma has, we know how it behaves, how it relates to theta, how it relates to vega. Okay, now it's time to optimize. And I will say to you folks, you can do it by hand. I mean, that's how most people do it. You can optimize your option trading just by following, if you want to do like long gamma trading, no? If you want to be either directional or not directional, but long gamma trader, is buy cheap gamma and sell expensive gamma, no? this is how it is. Okay, I have a volatility might increase in the near term, but implied volatility has to, unless we have a regime change. Ian is saying that he thinks that implied volatility is about to increase. Well, yeah, Ian, yes, it could be. I mean, if the bull market is over, then that's it. You are right. That's the only thing. But in the long term, from here until 2019, if the bull market is not over, if the bull market is actually continuing, implied volatility has to fall. And I have have my reasons for that. It's not just an opinion. I mean, the realized volatility is very low right now. Realized volatility is around, intraday is around 9%, and the last 10 sessions and 20 sessions, it has been around 14%. So VIX should be around that value pretty soon. VIX should be around 14s, and the whole term structure has to reprice lower. Of course, that is if the bull market is alive. Oh, but Ian thinks that the bull market is there. Okay, then I don't know. All bets are off. If the bull market is done, okay, guys, go and buy those long-term options. That will be even better. Like if your thesis is really, Ian, that the bull market is over, the best trade right now is just buy deep out of the money puts for 2019. Those puts might cost nothing right now, but if the bull market is over, those puts might increase 2 or 3 fold just on implied volatility alone. You don't even have to have the market falling 500 points. You only need implied volatility to go up. So you can buy puts at, like, I don't know, some outrageous value, 1800, no? Or something. Okay, you're doing it. Anyway, okay, let me see if I have another question. When you say buy cheap gamma and sell expensive gamma, that means you suggest calendar trade. Well, that's a way to do it. I mean, what I'm suggesting is in general. In general, is doesn't matter how you structure your portfolio. This is what I would like to do if you are a long gamma trader. My suggestion is mostly like, okay, enter a position that has cheap gamma, and when that position, when the gamma of that position has increased near the peak, sell it. That's kind of what I'm trying to do for a single trade. And now, if you want to create complex trades, yes, it's more along. Calendars are perfect. You mentioned. Okay, so let's continue. Let's go back. What is a high gamma number? How do we know what gamma is high? Oh, so you know that when gamma is high, if you plot, for instance, if you plot the gamma profile for the expiration, let's say you're plotting any expiration. So gamma is cheap, and you know that gamma is high if you have a single option when the option is about to become in the money. Tony, that's how you know it. So you buy let's say a 2,800 call for SPX, then it will have a decent amount of, like, low amount of gamma right now, but if the market moves up towards 2,800, you can be assured that when that option starts to becoming in the money, gamma is already peaked. So you, even if you don't know the specific values of gamma, you know that around the at the money is gamma is very plentiful, and you should sell it there. Okay, so sorry for the detours, but I like the questions. No, I really like the questions. So okay, so now how we optimize this by hand? We optimize this by hand, as I mentioned, selecting cheap gamma. So cheap gamma, what is? Cheap gamma is near term, out of the money. I mean, it doesn't have to be completely like zero gamma, but I mean cheap. And also that don't decay much. Now, from out of the list, remember the 2-day ones decay really fast. So you have to kind of do a balancing act of picking options that don't decay too much. Also, the hit max peak gamma for the move that you want. I mean, your thesis says, oh, I think this is going to move 10 points in 20 days. So your option should hit the peak. I mean, should become at the money or in the money, just barely in the money when the move happens. So it's an easy way to design the trade. And also, that doesn't lose much money if the move is against you. And finally, you have to take into account the effects of Vega, because implied volatility goes up and down, up and down. So if you, by hand, conceivably, it's possible to do these things, no? These things can be done by hand in a conceivable way. But what I did, in the other hand, is create the gamma optimizer. I mean, the gamma is better to just allow software to do these kind of things, no? Because by hand is too hard, but if you have software can help you identify. The gamma optimizer is a very simple tool. It's not a magical tool, folks. It won't tell you where the market is going. It won't tell you where it won't tell you like the targets for things that you already have to have a view of the underlying. You have to have what I call a thesis. You have to have your thesis. You have to know, okay, is this thing moving up or down, and how much, and in what time frame. I mean, you have to have an idea of what you want. You cannot trade blindly. But once you have that idea, you can really come to the gamma optimizer, and the gamma optimizer will select the top 3 options with different expirations for that particular idea. And those options have already, like all of this optimization that I talk about, happen under the hood. Now, it happened magically behind closed doors, and you will get a list with the options that will satisfy your thesis the most, no? And it tells you, like, this is an old screenshot. It has changed a little bit, but it tells you the return, the expected return that you are seeing. And it tells you also the risk reward for the trade, no? So it will tell you, okay, how much, in this case, risk reward of 10 means that you are risking, that you are making $10 for every $1 risk. So you can see, I mean, there are many parameters to design a trade. I like to design trades where risk reward is my most important parameter, other than total return. So I tend to go for the trades with the biggest risk reward, even if the return is not the maximum. But it's up to you, folks. You can do all sorts of things, you know. I don't have a live demo because I'm using the slides, but you could visit the website and you can play with it, and there is a YouTube video for how to use it. I want to say that this is a long gamma optimizer. No, this is for option buyers. This is not for selling options, because the optimization for selling options is kind of simple now. You sell near of the money. The question is, with the gamma optimizer, work with Thinkorswim. No, I mean, the Gamma Optimizer is just a web app. It's just a little web page, and if you have a web browser, you can use it, and it gets real-time data, it gets real-time quotes, and you can design things all real-time, you know. But you cannot place trades from there. I mean, it's kind of like you have to do the step. You analyze. It's more like something to help you analyze. You analyze, and it tells you, okay, this is a good one, and then you go to your favorite platform, and you execute the trade from your favorite platform. Oh, thank you, Don. Yeah, that's the website from Don. Yes, must get 3. Okay, this is a good one. I never bet on a horse as a favorite. Must get 3, 5, 8 to 1 return. Exactly. I mean, you have to have good returns. Now, risk reward is, to me, is the key to be a successful trader. I trade for a living. I don't do anything else. I mean, I'm just a full-time trader, and I have this website where I I have the optimizer, and we have a room. No, I have a room where I answer questions, or people ask me to suggest ideas or some trading ideas, or maybe you have your own idea but you are unsure how to express it. Then I help you kind of design of these things. Again, Richard, it is an independent web application. If you have Chrome or any web browser, you just go there and it just runs there. You don't have to install anything, and it's kind of an analysis tool. So I don't know if TradeStation could be configured to kind of launch websites externally. Maybe you could do, like, create a macro button that does that, but I don't know. I'm not sure. And so that's what I was talking about, the Gamma Optimizer. You have to know what you're doing. I mean, this is not a magic bullet, as I say. This is not a system where it will make money for you. This is a tool to assist you in making money. And that's it, I guess. If you have, folks, any questions, just let me know. You're welcome to visit my... What is the best way to contact me? Okay, you can contact me at that web page that Don have there. There is a free trial. If you visit the page, you will have 15 days, not credit card required. You just can go there, join the Gamma Optimizer room, and see if it's something that you like, if it aligns with your style of trading. Of course, I trade in many different ways. The Gamma Optimizer it works for one particular way of trading options, but I do all sorts of trading options. I have other optimizers, but they are not public. I mean, I only use it for myself. How does it work for earnings? Okay, I do have a tool for earnings. I mean, I have lots of tools. I am talking only about the Gamma Optimizer, but in the website, yes, I have a tool that is called the Gamma Central, and the Gamma Central does earnings analysis. And again, I mean, it doesn't guess where the thing will go, but it shows you implied moves and expected volatility collapse and statistical information about past earnings. It's really useful if you really want to trade earnings. And if did you give trade recommendations? Okay, yes, I do. In a sense, I mean, I trade for my own, and I share with the folks at the Gamma Optimizer room. I share my own trades too, but mostly I do requests. No, you have ideas that you want to do with options and you are not sure how to do it, I can help you. No, it's mostly like guidance in that sense. So even, you know, any idea you have, I can help you with that. And I generate my own ideas from time to time. Well, I mean 2 or 3 times per week. Any other questions, folks? Oh, what markets do you trade? Okay, as a personal, for personal reasons, I only trade SPX and I only trade VIX. Well, in fact, I only trade section 1256 contracts or 1265. I forget the number. Like the contracts that are tax advantage. So XPX options have tax advantage for long-term capital gains and short-term capital gains. So I tend to trade those on my own. But as I say, I will do anything. You know, we do everything. I get requests about metals and gold and GDX and pretty much anything that has options. No, I have seen requests for things that have very few options, but I'll do it. And no, options are really yes, of course. The SPX trades are basically can be expressed with ES also. So if you are a fan of ES options, then yeah, you can use them. It's not that hard to translate the trades into ES. They are also advantage contracts. So equal SPY, yes, SPY. Can you demonstrate how you might use the GO to optimize a back ratio? No, the Gamma Optimizer only does single options and verticals. It's a long thing. If you want something like back ratios, I can do it for you with other tools, but I don't have like a simple tool. I've been considering for the longest time to make like a full-blown professional simulator available, but I don't know if there is a market for it. I mean, I don't know if there are enough like advanced option traders out there that are willing to pay for use it. But so I have one for me because I use it for my own, and so I share it in the room. Once in a blue moon, I get this kind of request, and I do it. Do you mostly trade single versus spreads? Well, I trade very complex spreads. For in the Gamma Optimizer room, I mostly trade very complex spreads, but sometimes there are good edges with single options, or sometimes there are good edges with vertical call spreads or vertical put spreads. So I'll do whatever has the best edge for the particular thesis I want to trade. What average return you like in average trade? So I don't look for an absolute return, as I mentioned, John. What I look is for risk reward. So if I design a trade and the trade is giving me 10x, so I mean if the trade is giving 10 times what I'm risking, I like it. So of course a 10x risk reward will translate into something like 1,000% return, like it's an outrageous return. But I look for risk reward. And of course we have to consider that long gamma has these really cool, nice risk rewards profiles where they are like fantastic 10, 20x because that's how profits accumulate. But if I'm doing a short gamma position, a position where I'm selling options, you should never expect those kind of things. You expect probably 2x or 1x. And I do trade SPY and I do recommendations. Can you give us an example with a single trade with 10x? Yes, for instance, I can give you an example right now. I mean, from the top of my head, the easiest trade is if you're bullish SPX for next week, for instance. This is an example trade. I'm not, please don't trade it. I just giving an example. If you're looking for something like 2,810, and in fact, I am looking for 2,810 in XPX for next Friday, not tomorrow, but next Friday. There is a vertical call spread for it that it costs around 40 cents, 42 cents, and it pays $5. So it's a trade that costs you 42 cents and it pays 5 if you get it right. So that's a 10x trade right there. And so the good things about those trades, Tony, is that you don't have to get them all right. No, you notice that if you do one successful trade like those, will be able to eat probably 8 losses in a row. So that's what's called about the statistical edge, and this is something I call all the time in my room. The statistical edge, positive edge is the name of the game. Mike, since SPX and VIX have opposite relationship for price and volatility, does the tool adjust automatically? Yes, the Gamma Optimizer tool, it has a full volatility surface simulator. So of course, if something moves up, in particular, if XPX goes up, we know that implied volatility will decrease and it will affect options. And the Gamma Optimizer has 2 levels of simulation. It has a standard volatility surface, which is kind of fast and works most of the time. And I have a full stochastic volatility model if you really want to have like full precision for positions that really require the full modeling. In particular, if you are trading a crash in the market, you want to use a stochastic because volatility will explode and you want to benefit from that volatility explosion. Okay, folks, it's lots of interesting questions. I guess time is already an hour, and I really appreciate that you are here, and I hope you enjoyed this webinar. If you like, visit me. As I say, we have a 15-day free trial, no credit cards, nothing. Just go there and join the room and enjoy it. Ask me questions. I'm always available all day long. I'll answer questions all the time. I love answering questions. Thank you, folks, and thank you, Don.
Thank you, Leo, for your time with us this afternoon, discussing your Gamma Optimizer tool. We were very happy to have you with us today. Come back to TradeStation tomorrow morning for our morning market briefing. We begin 1/2 hour before the market opens. 1/2 hour before the market opens. Tomorrow our presenter is Mr. Sam Seiden of the Options Online Trading Academy, and he'll be with us tomorrow. Thank you.